a couple of points, and then Jessica's been taking some notes as well for any questions. But one of the things, and you just kind of said it at the end, that I'm really trying to explain to people, especially business owners, real estate agents, investors, is that if you take out a traditional mortgage, you're not able, and you pay it down. Let's say you pay $50,000 down on the principal balance, which would take you a long time to do, but let's just say you do that. You cannot access that money unless you refinance or take out a second mortgage, which would be a line of credit or a second mortgage. Where with this product, you can really use the funds to grow and scale your business, because a lot of times businesses need money for marketing, for overhead, for more products, maybe they buying another investment property. And this is a really great tool to use on your home, whether it's a primary, second, or investment property, but then be able to tap into that equity to use that to make more money. And I think that's one of the, key features of this product. A lot of people get into it because, they want to pay their home off in record time, which will also free up more money as well. But sometimes I'll talk to people about doing a refinance, and they'll say, you know what, I'll say we can go 80% loan to value based on whatever the value is. Oh, I don't want to do that. I only want to pay off what I currently have. My goal is to pay it down quickly. Well, the good thing is that you're not paying the interest on the total line if you don't take that full amount out. So it makes sense to do the 80%. So that way you have access to, God forbid something happens, you need emergency funds, or all of a sudden, your child is going to a more expensive college, or whatever the case may be. So that being able to tap into the equity is a huge benefit of this mortgage, and you're gaining equity a lot quicker because you're able to pay off the mortgage a lot quicker.
And let me add this too real quick, Danielle, on that note, there another great feature, especially for the home buyer out there with maybe more than the minimum down payment amount. Oftentimes people are willing and want to come in and reduce their initial a debt size on a traditional loan. And I've seen this where, they're contemplating coming in with, let's just say 30% as an example, down payment on something, where, to your point, we could qualify that same home buyer to an 80% level line of credit, all in one loan line of credit. They can still come in with their 30%. But in our situation, we are going to keep liquid a portion, right? 10% of their down payment available to them to tap into or use down the road if they want to or need to. So we're going to keep it liquid. And I think it's really appealing to some of those folks. We can also use this obviously for delayed financing. Cash buyer comes in and wins a contract and closes on that home. The day after that, we can take the loan application, do a cash out refinance without any seasoning requirement, to where they can obtain back up to 80% typically the money they came in cash with to buy that property. So a variety of different features, an asset depletion feature where we can just use assets to help qualify, and that's really going to help out with business owners.
That's
where
huge.
maybe their tax returns, it is. Maybe there's a little bit more complex situation where the way they, structure their tax liability to help reduce it. This is a phenomenal way to say, hold on a minute, maybe we don't even need your tax returns. Maybe we don't even have to run IRS transcripts. Let's just take a look at your assets and see if we can't use our asset depletion feature, which is our methodology is pretty aggressive, but in line with industry standards, and essentially help somebody qualify without having to go through, the rigmarole of qualifying using their tax return. So a lot of nice features for business owners. Self-employed, of course, the real estate, investors, anybody that's looking to buy, or simply, frankly, people that already have a mortgage, that otherwise think that they're sitting in a really good place. And take a look at the total bottom line. How much interest are you being charged, and are you committed to already? And how is that impacting your wealth potential?
Right.
By and large, statistically, it impacts it immensely.
Yeah.
So,
Yeah, And I can personally, we've had somebody self-employed, a lot of people write stuff off or write a lot of things off on their taxes, and they would not have qualified for a conventional loan, but they had enough assets. So I was able to do an asset depletion. And in fact, the all-in-one loan was the only loan they qualified for. Good thing they wanted the all-in-one loan, but that really was the only loan that they would qualify for based on the asset depletion and the way that we were able to do that. One thing I also want to mention on the flip side, and conversely, what you were talking about, if somebody is a cash buyer and delayed financing, a lot of times I'll have somebody that says, you know what, I really don't want a mortgage, but in order for me to buy something, I need to sell my house first. Well, my house is not going to be sold by the time I buy the next one. However, my plan is when I sell my current home, you know, I can buy the next one, not have to move out yet. Then when I sell that one, put it down on the line so they actually have no mortgage afterwards, but still have access to the equity and they're not paying interest on it.
Yeah. Yeah, absolutely. You don't have to close this. It doesn't close automatically. Imagine reaching zero on your balance and having access to equity money over 30 years without having to refinance again. Think of the variety of things that you could utilize this for. I mean, I like to always say there's no required shift in behavior or budget, but certainly it does sort of change the way you think about mortgages and money, you know, and how other people tend to use or benefit from our money more so than we get to benefit from our own money. This changes that. People get to actually act as the bank of themselves, right? They actually get to really function as the banks do.
Right. Exactly. So another question I get a lot is, and you kind of answered it, but I just want to, you know, make sure everybody understands it, is they'll say, well, what's my monthly mortgage payment? And to that extent, I say there really isn't a monthly mortgage payment. It's the interest payment, which is going to be different depending on your cash flow for that particular month. So can you touch on that a little bit?
Yeah. So in the traditional sense of making a payment, we all know how it works. We send away a monthly amount, whether it's for a car loan, a mortgage, a student loan. I mean, most loans in America are structured this way, where we're sending away a lump sum of money. But within that lump sum of money is part interest and part principal, right? It's sort of hidden how much of your money is going towards each month. And that's the downside. We're not engaging the debt and engaging the amount or control of it with how much is going to each of those, right? To repay the debt that you've borrowed, the money you've borrowed, or to pay the interest on the borrowed funds. We don't control that, and it's somewhat hidden. The greatest thing about the all-in-one loan is that we separate the P from the I. The principal that you owe, that a customer owes, the repayment of that principal is simply done by making deposits. You make a deposit, bam, it's a principal reduction payment that day. But that principal reduction payment, by whatever amount you just did it with, remains liquid. So it makes it feel very comfortable and safe, you know, because a lot of people go, gosh, if I you know, I do have extra money at the end of the month, and I don't spend all my money on just one day throughout the month. So would it be nice if I had a checking account that just, you know, applied it to the debt automatically and allowed me to pay my bills directly from it? So I'm saving interest even on the money I have to spend. But think of deposits as the principal repayment. Anything you leave in the line of credit resides there as principal reduction. It already goes to principal, kept liquid, but goes to repaying the debt. The interest payments are a separate event. And what happens is the interest is being computed nightly at midnight, every single day. Whatever you happen to owe today on my own loan, whatever I happen to owe today, tonight at midnight, times my interest rate divided by 365 days is today's interest expense. I'm not charged that daily. It's just recomputing, you know, behind the scenes in the system automatically. Tomorrow, if I get paid, my balance goes down. It reduces that, you know, tomorrow's interest costs. This occurs every single day. And at the end of the month, that's going to total up for the month of May, 31 days in May, 31 days of cumulative interest, $18 here, $18.10 there, maybe $19 that next day. Maybe it dropped after a deposit down to $15 that day. The total, you know, amount of interest from each day is summed up, and that becomes my interest payment. And that's simply drafted from my all-in-one loan line of credit on the 21st of the next month of each new month. So interest paid for on a separate day than how you pay down principal. Deposits pay principal. the minimum payment obligation on this loan is just the interest, and that's an automated interest payment,
Right.
so that you don't have to worry about it.
Which will bring me to my next point, because there are a lot of business owners, and real estate agents or anybody basically on straight commission, where businesses ebb and flow. Like, you don't know, okay, every month I'm going to make this amount of money. So if you have a couple of great months, but then, followed by, let's just say 3 or 4 months, or maybe you have stable income, but you lose your job and you're out of work for a couple of months, right? As long as you have equity, whatever your balance is to whatever the line amount is that you took out, you don't have to make a payment, right? That interest is going to add up, but you're not going to get a 30-day late on your credit report, right? You're not going to have, be risking foreclosure with this particular product, where if you're in a traditional mortgage and you have a couple of really bad months, or lose, God forbid, your job and don't make a mortgage payment for 6 months, well, you're possibly heading into foreclosure or forced to sell your home. Where with this product, not that you want to use it for that, but it also gives you that safety net as well.
Yeah. And we've had plenty of stories, honestly. I mean, we've had, again, you opened up with this, we've had the loans out since 2005. So we went through the 2008 financial crisis. And I can tell you that we received letters from people, correspondence inbound. I can remember one such correspondence in which the president of our company, our founder, read the letter to a lot of us, just over a teleconference meeting. And it was just really emotional. It was just an emotional story about a couple who, actually, it was one of the husband, I believe, had passed from cancer, and his wife was. They had 4 kids, and they were just, she wasn't in the workforce. She wasn't working, hadn't worked. She was a mom full time, but she was able to not have to worry about her house. She didn't lose her house. They had enough equity in our loan in place where she was able to just get through that, begin to enter the labor force and begin to generate income without worrying about potentially losing their house, or being foreclosed on. These things happen. I think if there's one thing constant in life, it's that life throws us curveballs, right? The one thing that it is consistent is that life is inconsistent, and there's going to be some financial challenges that come our way, maybe next month, maybe in 6 months, maybe next year, and we've got to change directions. The maneuverability with this product, without having to refinance and having the money securely there available for you, I think is, really the biggest attribute.
Well, which is actually going to just bring me to my next point, and they kind of go together. I got this question today, and the question was, this sounds like too good to be true. What's in it for the bank? Sure.
We get that a lot. It's all about risk and reducing risk and creating a stickier relationship. One of the biggest I think benefits to us is that the credit quality, the kind of financial quality or financial behavior of the customer that tends to gravitate to this loan and get it and they understand it and they use it effectively. Clearly we do a lot. We put a lot of effort forth to coach and educate and really reach the right amount, the right people for the right reasons with this product. We're not interested in trying to sell this as a one size fits all solution. It's not, but it's an extremely dynamic and powerful tool for those people who are cash flow positive and have some financial discipline but want to maneuver through life using this tool can provide a lot. It also creates a stickier relationship for us. If we were to make, somebody a 30-year fixed and just apply statistics to that customer and to that loan, chances are we'll lose that customer in 5 years. They'll find a reason to refinance their mortgage or sell their home. There's going to be a reason in most cases that people change their mortgage about every 5 years historically. And lenders, as you know, Danielle, spend a lot of money and a lot of time trying to retain customers. Customer retention is extremely expensive and cumbersome. Or we spend a lot of resources replacing customers that we lose because of this vicious cycle, this endless cycle of, recycling mortgage debt for whatever the reasons. If instead we just developed a mortgage product that you are a whole lot less likely to need to get out of or want to get out of because it creates all this flexibility and control over an extended period of time, guess what? We tend to not lose customers as frequently as we would with a traditional loan when we supply them the all-in-one. In fact, we actually have the opposite. People refer or want additional all-in-one loans on additional properties, which we can supply, by the way. We can do more than just one per borrower. So, what's in it for us is that it reduces risk. It's extremely hard to go late and default on this product. So it reduces risk to us, and it creates a better relationship, a stickier relationship with customers. It's just that simple.
Yeah, exactly. And I think, a couple of points on that. First of all, when you get a mortgage, and as you said, most people are paying it off every 5 to 7 years, the banks know that, right? So the first 5 years to 7 years of your loan, you're paying almost all interest. Very little is going towards your principal because they know, they expect for you to be, refinancing or selling or paying off your loan in about 5 to 7 years. Where with this particular product, you never have to, unless you're selling the home, you never have to really refinance again. I mean, this creates a long-term product for the bank because for most people, the only reason they're going to pay off their mortgage, aside from a purchase, is either to refinance, to get cash out, or reduce their interest rate. And if they're reducing the interest rate, it's because they want to obviously pay less interest in hopes to pay off their home a lot sooner. If they're getting cash out, it's to, do whatever, put in a pool, buy investment properties. So with this loan, it does both of those things, which are the two main things why people refinance anyways. So,
and you just answered the question, Danielle. I think that a lot of times people want to also know as a follow-up, if this is so great, why aren't other lenders and other banks, and why isn't this mainstream? Why isn't everybody out there offering it? Well, you just answered that question. It's literally, it's less profitable. I mean, we don't have a guaranteed rate of interest income. And we could supply this loan to somebody and they pay to zero in 2 months, but that's the benefit of the loan. Chances are they're going to want to leverage their money and go do something with that downstream, or maybe not. That's fine. But that's the reason why most lenders and banks aren't going to want to offer something like this. There's less of a guarantee of interest income to them. For banks specifically, most banks don't want to offer this because they want your money to reside in their checking accounts so that they can leverage those dollars and borrow against them to make more loans. Well, in the all-in-one loan environment, your money doesn't reside in the checking account. So, from their perspective, it would cannibalize, their business model in a sense. This actually is a physical sweep of your money, digitally, securely transferred out of the checking account, instantly over to the HELOC to pay down the principal balance, all visible to you online and through the app. And so it removes the benefit, the leverage that banks get and gain and rely on by us leaving our money idly sitting in our checking accounts, even if for a day that they're leveraging our money. This takes that leverage away from them. That's why they're not interested in offering the product. I mean, so, sometimes there's good guys out there, good guys and gals that generate, innovation and really believe that what's good for the customer is good for us. And this is one of those cases.
Absolutely. So last and final question, and I think I've said that a couple of questions ago. Do we have any others, or is this?
It's just someone put in there, they didn't see any flyers or your information.
Okay, I'll send the flyers and information on that out afterwards. But last and final question is one of the questions I do get asked is, does it cost to sweep? A lot of times the sweep account, there's a cost every time it sweeps, and they get nervous, like, oh, the sweeps every day, that's going to be a lot. Sure. Well, that would not make sense. So there isn't any cost when it sweeps over. No. What are the typical costs?
Yeah, I mean, so as a line of credit, there is an annual fee. It's a whopping $60. There are some states where there's no charge or less of that charge. At the most, it's $60. So it's a $60 annual fee, and that's waived the first year. Why is there an annual fee? Because we don't charge. We typically actually reimburse any out of network or third party ATM transactions. So if you were to use your your all-in-one loan ATM debit Visa card to pull some cash out, say you go to 7-Eleven and the network owner of that ATM machine is going to ding you $5 and you say, yes, I need this money. So I'm going to pay $5 to get out my 20. Well, that $5 surcharge fee is going to get reimbursed to you automatically each month. And so, and believe it or not, we feel very passionate about that. We think that this should be an account that is not rich of fees. That's not what we're trying to structure here. What we structured is a mortgage security to help people get out of the debt faster and live more flexibly and independently, not to make us rich off these little nickel and dime fees. So we're going to reimburse those surcharges back. The annual fee is a little bit of recoupment, a small portion of that recoupment annually for the transactional use to basically service the mortgage product and checking account combination over 30 years. So other than that, if there's any other third-party fees that are related to using the account, those are typically again reimbursed. No fees for the sweep whatsoever. And in fact, I would argue that you're without a mortgage that sweeps, or without a checking account and mortgage that sweeps and uses your money to reduce your debt, you're already paying higher interest than you need to. You're already being charged a fee for not having a sweep function. Our loan provides the sweep function to help you save mortgage interest at the rate of the loan itself. Let that sink in. Do I put my paycheck over here and earn 0, or do I put my paycheck over here and save 4.5% or 4%? I'd rather go save more money than I could earn over here, right, with the same dollars. So, but no transactional fees, no fees for sweeping whatsoever.
Perfect. So that's pretty much it. I mean, we really covered everything. I will be sending out the recording of this. I know a lot of people were looking to get on. I don't know if something happened with the Zoom link, but I will send that out to everybody and my information as well. I really appreciate all of the information. Like I said in the beginning, I personally have this. I just refinanced a couple of months ago on the product. We had a lot of money just idly sitting in other accounts, a couple of different checking accounts. So it's really helping save, and pay this down so much quicker, with having the flexibility to be able to use it for other investments and things like that. So I think it's a phenomenal product. I do remember it back in 2005. And then, I kind of forgot about it for a little while in the craziness of the market, but I'm so excited to have it back. And, it's not, like you said, for everybody, but the people that it is right for and the people that get it are just like, oh my gosh, I want this product. So.
And the calculator is a big part of that suitability test. We just do not provide this product unless there's an enormous financial benefit. Yes. Period. We don't necessarily position it as just a HELOC to go leverage and take on more debt. Instead, we want to see people, methodically reduce that debt at an accelerated pace. And it does that for our customers automatically. And so the calculator on the website is the best way to stress test financial benefit compared to a traditional mortgage. And we just don't do it unless there's a benefit.
Yeah, and I have that on my YouTube channel. So I have a ton of videos on my YouTube channel. I just walked through a simulator and videoed, myself. So there is a video on the simulator on the YouTube channel, because I do have to point out that two of the biggest pieces of the simulator is how much cash flow is flowing through that checking account each month and how much is left over. And so those are the two pieces that are really important that you know the answer to in order for you to have an accurate reading on that simulator. So I did walk through a purchase, and I'm going to do one on a refi as well. So
great. That's super. Thanks for having me, Danielle. I really appreciate it.
Yes. Thank you so much. Bye, everybody. I'll get the replay out to you. Thank you.
Bye now.